Welcome to The Explainer. Today, we are going to pull back the curtain on the stock market. We're going to forget all the complicated jargon for a minute and just build a really simple but super powerful framework to help you see how this whole thing actually works from the ground up. You see all those numbers flashing across the screen, right? Red, green. It looks like total chaos, maybe even a little random. But believe it or not, underneath all that noise, there's a surprisingly simple and predictable force driving every single price change. A lot of people think of the stock market as this giant casino, just a high-stakes game of chance. But it's way more accurate to see it as a massive global auction where millions of people are constantly negotiating the price of a company's shares, literally second by second. And the engine that drives this entire auction, it's just good old supply and demand. Just picture this. You're at a farmer's market, and there's one person selling one perfect peach, but 100 people want to buy it. Well, that seller has all the power, right? They can charge whatever they want. Now, let's flip it. Imagine 100 sellers, all with perfect peaches, and only one buyer walks by. All those sellers now have to drop their prices to compete for that one sale. That simple idea is what moves every single stock every single day. So to really get a handle on this auction, we're going to build out a framework. We're calling it the 4 pillars of investing. And this is going to be our roadmap for the rest of this explainer.
All right, so who's actually participating in this global auction? At its very core, every single trade really just boils down to 3 key players.
So first, you've got the buyer. They're the optimist, right? They think the company's value is going to go up. Then you have the seller. They might be cashing in a profit, cutting their losses, or maybe they just need the money for something else. And connecting them both is the market maker. Think of them as the auctioneer, tweaking the price constantly to find that perfect spot where a buyer and seller agree to make a deal. Their only job is to keep things flowing smoothly. Okay, so in any auction, you gotta know what you're bidding on, right? You wouldn't just throw money at some mystery box. And that brings us to our very first pillar, fundamental analysis. This is all about doing your homework to figure out what a company is really worth. Warren Buffett has this amazing quote that just nails it. Price is what you pay, value is what you receive. The price on the screen is just what people are willing to pay today. But the value, that's what the business underneath it all is actually worth. The whole game is trying to find great companies that are on sale, trading for less than their real value. So, how do you figure out that value? Well, you basically have to become a detective. You start by looking at the big picture stuff, like how the economy is doing. But then you zoom way in, and you go through the company's financials with a fine-tooth comb. Its income statements, its balance sheets, to get a crystal clear picture of its health. And Buffett, he's the master of this stuff. He uses this super simple but incredibly powerful 4-part checklist. And a company has to pass all 4 tests. No exceptions. He has to actually understand the business, because you can't value what you don't get. He needs to see that it can grow for decades, not just a few months. He has to trust the people in charge. And even after all that, he'll only buy it if he can get it at a bargain price. All right, so finding a great company, that's just step 1. Knowing when to pull the trigger and actually buy the stock, that's a whole other ballgame. And that brings us to pillar 2, technical analysis. Think about this for a second. Companies can sometimes, let's say, get creative with their financial reports. We all remember scandals like Enron, right? But a stock chart, that's different. It's a totally honest, unfiltered record of what's happening in the auction, showing what real people are doing with real money in real time. So technical analysis isn't about predicting the future with some crystal ball. It's more like reading the body language of the market. By studying charts, you can get a feel for the crowd psychology. Are people feeling greedy right now? Are they feeling scared? And you can spot patterns that might just give you a clue about where things are headed next. So what does this body language actually look like? Well, the most basic thing it tells us is the trend. It's just answering a simple question. Right now, are people feeling good about this stock or bad about it? An uptrend literally looks like a staircase going up. It's a series of higher highs and higher lows. This tells you buyers are in charge. Every time the price takes a little dip, they jump in and push it even higher. Now, a downtrend is just the opposite. It's that staircase heading down, lower highs and lower lows, which tells you the sellers are calling the shots. And beyond just the general trend, analysts look for these key levels. Support is like a floor where buyers tend to show up, and resistance is like a ceiling where sellers tend to take profits. They also look for recognizable patterns, like this ascending triangle. This is a classic. Think of it like a pressure cooker. The price keeps bumping up against that same ceiling, but the buyers keep coming in at higher and higher prices. All that pressure builds up, and it could signal a huge breakout is coming.
Okay, so Pillar 1 tells us what to buy. Pillar 2 helps us figure out when to buy. Now let's talk about the good part, how you actually make money. And that is our third pillar, generating cash flow.
You know, a really common myth is that you can only make money when the market is soaring, what they call a bull market. But that's totally not true. The pros have strategies to make money whether the market is going up, going down in a bear market, or even if it's just going nowhere and moving sideways.
And this here, the cash flow quadrant, is all about a huge shift in how you think about money. See, most of us start on that left side, as an employee or self-employed. We trade our time for money. The whole point of investing is to get over to the right side, to become a business owner or an investor, where your assets do the work and your money starts making money for you.
And that brings us to what might be honestly the most important pillar of them all. Because great investing isn't just about how much you make when you're right. It's about how much you don't lose when you're wrong. We're talking about managing your risk.
I mean, just look at these names. Lehman Brothers, General Motors, Enron. These were giants, right? Household names that seems like they could never fail. And they did. It's a powerful reminder that if you don't have a plan to manage your risk, one bad trade can do some serious damage.
But here's the cool part. Risk management isn't just about playing defense. It's about setting yourself up to survive the storms so you have the cash and the confidence to scoop up the amazing opportunities that always come after a big downturn. So how do you do that? Well, one super practical tool is the reward to risk ratio. A good rule of thumb is to only take a trade if you stand to make at least twice what you're risking. The math here is your best friend. With a ratio like that, you can actually be wrong more than you're right and still come out profitable in the long run. And this isn't just some vague concept. Risk management is a real toolbox filled with things like stop-loss orders that automatically get you out of a losing trade, or position sizing, which means you decide ahead of time exactly how much you're willing to risk. The whole point is you have this escape plan figured out before you even click the buy button.
Okay, let's bring it all home now. Let's see how these 4 pillars click together to build one solid, complete system for tackling the markets.
See how this works? Each pillar answers a critical question. Fundamentals tell you what to buy, technicals tell you when to buy, cash flow tells you how you're going to profit, and risk management tells you how you're going to survive to play another day. Put them together, and you go from gambling to having a real disciplined process. At the end of the day, you will never be able to predict the future. Nobody can. The goal isn't to be a fortune teller. The goal is to have a system, a process that works no matter what the future throws at you. Because you can't control the market, but you can 100% control your own actions. Becoming a great investor is a journey. It's a process of always learning. But now you have the framework. You have the 4 pillars. And understanding that is the first and honestly the most powerful step you can take.